Hi, I'm Gates Dunaway with Tapestry Development Group, bringing you the last lesson in the HUD webinar series of Partners in Housing, Multifamily Housing Preservation Training. This is the basic course, and right now we're going to talk about sustaining affordable housing through the Low-Income Housing Tax Credit Program. This could be something we could talk about for a week, and so we're going to do our best to talk about it in a very compressed, probably less than an hour lesson. The goal of this is not to teach you how to use this program to its maximum potential, because it requires experienced partners and developers. The goal of this lesson is to teach you what the tax credit program can be for you and how you could access it and if it might be a good fit for you. So let's get started. The objectives for this lesson are to recognize the potential benefits that could be achieved through the Low-Income Housing Tax Credit Program. First thing to note is the Low-Income Housing Tax Credit Program, it's not a HUD program. It's actually a program that was authorized through the IRS. So this isn't a program that HUD offers to you, but it can be combined and used well with other HUD products. So we're going off a little bit in terms of what we had talked about prior. The Low-Income Housing Tax Credit Overview. This is an indirect federal subsidy, and we use it to finance the development or the renovation of affordable rental housing for low-income households. It was enacted by Congress in 1986 to provide the private market with an incentive to invest in affordable rental housing. It's awarded to developers of qualified projects who, in turn, sell these credits to investors, and then the sale of those credits raises equity for their projects. This equity raise reduces the amount of debt that the sponsor would otherwise have to borrow. Sponsors receive a dollar-for-dollar tax credit that they then sell to the tax credit investors, which results in equity to the project. The tax credit is allocated over 10 years, and investors receive a portion of it each year over the 10-year period. So this is this is a lot of detail about a program that's fairly complicated. Suffice it to say that the tax credit is an award that is given to an owner or developer that develops housing that is qualified affordable rental housing over the period of at least 15 years and usually for 30 years. The award of the credits is something that we then sell, as we being the developer owners, sell to the investors, and we typically sell them through what we call a syndicator. And a syndicator is nothing more than a broker, and the broker matches up the investors to the owners with the credits. And so they bring the equity to the table for you, and in return you hand them the tax credit that they use to bring down their tax liability. Let's keep going on the tax credit overview. The amount of the annual credit is based on the amount invested in affordable housing. So there's a formula. We won't go into all the details, but the amount of credits, the amount of tax credits you generate is based directly on the amount of money you spend on the project. Tax credits can be used either for new construction or for the rehabilitation and preservation of existing affordable housing projects. You can combine tax credits with HUD rental assistance programs, and you can also combine it with HUD mortgage insurance programs. As we discussed in the last lesson, you can combine it relatively easily with FHA 221D4 financing, and then through a new pilot program, you will be able to use it with the 223F program in certain cities initially and hopefully throughout the country. Owners can get a developer fee as a part of the transaction. So that's a big deal. The limitations on the developer fee somewhat are raised. If you're a nonprofit, you're going to put your project into what we call limited partnership or limited liability corporation, and you will be a general partner generally in that project, or you'll be a co-general partner, and you will by right be able to earn a developer fee, which is sometimes new revenue for nonprofits that prior to a transaction like this might not be able to access any sort of discretionary funding like that. And a property owner, as I just said, is going to be typically either a limited partnership or an LLC, limited liability corporation. And this new investor, and this is often a big shift for most, especially for nonprofit owners, your investor becomes the limited partner in this deal. They become the 99 and often 99.99% limited partner. And the general partner, which typically can include the original owner, or you may be selling the property to someone else that's going to continue this mission, they will be the 0.1 or 0.01% general partner. This is a quick slide that just compares tax credits to tax deductions, just in case. So a tax credit is subtracted directly for your tax liability. So if you owe $1,000 in taxes, and you have, if you have a $1,000 tax credit and you're in a 15% tax bracket, which doesn't really matter in this example, you reduce your taxes owed by the $1,000 of credits. So it has a large impact on reducing your tax liability. And if we contrast that to a tax deduction, you basically subtract from your income the tax deduction to determine your tax liability. So if you have a $1,000 tax deduction and you're in a 15% tax bracket, this reduces your taxable income by $1,000, but it only reduces your tax liability by the $150, the 15%. So it obviously has a smaller impact on your tax liability. We like tax credits. The additional benefits of tax credits compared to market rate housing, and I'll say there's some of this that's a little bit a variable, but the bullet says lower debt service payments. What that really means is that in a tax credit project, you are able to leverage much, much more equity than in a typical market rate development with market rate financing. Therefore, you borrow less money. Therefore, necessarily, your debt service payments are smaller than they would be in a market rate deal. It says here you also have lower vacancy rates. That's not always true, but generally speaking, a tax credit deal is going to necessarily, and through the program restrictions, it's going to set the rents at a lower level. And therefore, at lower level rents, you're going to compete better in the market, and you're, in theory, going to have a higher occupancy rate and lower vacancy rates. Tax credit properties also typically are leased quickly due to the lower rents that I just talked about. So in general, the idea is you're bringing your rents down to a level that competes better than the market, and you can lease up more quickly. And then it offers a strong potential economic return due to the tax credit. Well, it offers the economic return to the investor because they get the tax credit, but you also get other things in a tax credit deal that may not be as readily available in a market rate deal. One is basically the higher developer fees that are allowed. Let's talk about securing tax credits. There are two ways in which you can get tax credits. We have two types of tax credits we discuss. One is called the 9% tax credit, and the other is called the 4% tax credit. So a 9% tax credit, which is, if you do simple math, it's going to be a higher amount of tax credit equity. These are allocated on a state-by-state basis, with the exception of a couple cities also have allocations that they have separate from the state. And this is allocated in a very, very competitive process. So when most people talk about getting tax credits, they're usually talking about the 9% tax credit program in this competitive process. And it varies from state to state, but each state sets up its own criteria for evaluating and awarding points to giving out their tax credits. And you really would have to understand the state you're in to really know what's more favored in your state. And I would say also it varies year to year. Most states take their plan, we call it the qualified allocation plan, and they typically will change it every year, and it could be changed to respond to different trends or different needs. We see some states that favor projects in rural areas by giving them more points, and then perhaps a couple years later, the points will go to the urban areas. So it's really a very local flavor of a process, and it's important to know what your state has for you if you're thinking of a tax credit deal in the competitive world. And the best way to do that is to research what your state housing finance agency is. They always have a nice website, and go and look at your qualified allocation plan for the current year. If you are in a current year that the cycle has already had their applications turned in, you can get an idea of what next year might look like, but you really need to check back and find your qualified allocation plan when it comes out for the coming year. We can contrast the 9% competitive credit with the 4%, what we call the tax-exempt bond program, that it comes with a 4% credit. So the difference, besides the size of allocation, is that the 4% credit is something that comes as of right with a tax-exempt bond issuance. And it's a non-competitive process. And because of this, it often is a solution that works well for folks that where the 9% competitive process might not be that accessible for them, perhaps because of the scoring. However, I will say that the 4% credit nets you less equity. Therefore, you have to be able to balance your deal with fewer amount of tax credit dollars. Let's go through the 9% allocation process. Like I said before, the IRS, it's an IRS program. It allocates to the housing tax credit agencies in each state. It allocates an award of tax credits. It's generally $1.75 per capita for each state. And then those are then issued by the state in a competitive process. There's some federal requirements that each state has to adopt in their setting the standards for how they're going to allocate credits. They have to, through the allocation, they must serve the lowest income families, and they must be structured to remain affordable for the longest period of time. And the way you'll see this play out in the actual QAP, the Qualified Allocation Plan, is typically deals, projects that come forward that have that restrict more units for lower income families will receive higher points or receive more points. And then to address the second item, typically projects that commit to remain affordable beyond an initial 15-year compliance period, so for 30 or 40 years, will receive favorable points. The next point on this slide says that 10% of each state's annual housing tax credit allocation must be set aside for projects owned by nonprofits. And I think this is true everywhere. Some states, I would say, favor nonprofits more than others, and by that, some states go well beyond the 10% allocation. Some states just meet the 10% allocation. I think it's a state-by-state issue, and it's a state-by-state preference. And lastly, this is a competitive process that uses criteria that's set by the state agency, and often they have set-asides that prioritize preservation of affordable housing. Again, I caution you, go to your state's QAP and find out what they do prefer. Some things to note about the 9% allocation that you can find out through you're looking at your qualified allocation plan is often that each project is, your applications are what I would call capped. That means that you can only apply for a certain amount of credits, a certain amount of tax credits per deal. This might limit the amount of units you can renovate or you can preserve through your housing. For instance, where I am in Georgia, the amount of credits that you can get per project limit you to about a 90 to 120 unit project. If it's something higher than that, the 4% program might work better because there is no cap on the amount of credits per project. Also, typically the 9% program, and we're finding more and more the 4% program as well, has a minimum standard for experience. And so this is where, if you're new to this program, and this is the first time you're hearing about it, you should be cautioned that almost every state has a very strict experience requirement that you must meet, meaning you typically have to have a certain number of projects completed in the program and running well. And if you don't meet that standard, oftentimes, and hopefully they have a way for you to meet it through partnering. And because this is a complicated program and it's got its own set of documents and nuances, we do mostly recommend that anyone who hasn't done it before must partner so that they can be sure to be taking advantage of it in the right ways and not tripping up through the application process. The tax credit amount for a project is calculated based on, and we talked about this a minute ago, the cost of the development, so however much you're spending on the actual development, and then the number of units that qualify as low income. So in the tax credit program, low income is defined as 60% of the area median income or less. And then the amount of tax credits awarded, they cannot exceed the amount needed to make the project feasible. And that's just a bullet to say there's a check that's done, and it's actually a cross-check with HUD. Oftentimes people are combining HUD funds with tax credit funds. There's a program called the HOME program, and you can't over-subsidize your project. You just need to be aware that there's a check that's done there. Let's look for a second at the tax-exempt bond program. Properties financed with tax-exempt bonds are eligible for tax credits without having to compete for the award from state agencies. Projects must have 50% or more of the project cost financed with tax-exempt bonds to qualify. So if you do some quick math, I'll just say that in a 9% deal, in a 9% tax credit deal, you often see 80% equity, 20% debt, maybe even 100% equity and 0% debt. In a bond project, you have to have at least 50% of your project be debt, which means the other 50% might be equity. So right there you can see that a tax-exempt bond project is going to carry more debt than a 9% program project would. Tax credits are, of course, awarded for the 4% of the eligible project costs. We have a slide here that compares the 4% and the 9% program. The allocation method in a 4% deal is an as-of right with tax-exempt bonds. And in the 9% program, it's, of course, competitive. The allocation limit. So that was I referenced that earlier. There's an unlimited amount of credit that can be allocated in a 4% deal in terms of how much you can get for a particular project. But in a 9% program, it's often capped per project. So it might reduce the number of units that can be assisted. on the maximum basis. So we didn't talk about this, but basis is the amount of development dollars spent upon which you calculate your tax credits. And this is a little more complicated than we need to go here, but basically in both the 4% and the 9% program, if you are located in a qualified census tract, which is a census tract that I believe has more than 50% of its residents meet the definition of being poverty or low income, then you will qualify for what we call a 30% basis boost. It just means it's going to attract more equity and more credits to your project. In the 4% program, you get this 30% boost in a QCT. And in the 9% program, there's been a change that actually lets the state have discretion, and they can make any area in the state qualify for a boost. So what that says is that in a 9% program, which already attracts more equity, you have potential to attract this boost where you might not in a 4% project. And then we're going to skip the next line. It says the value in terms of total project cost. And so this last line is a little more than we probably need to talk about here, but the 4% credit rate, there's a mathematical formula that tells you how many credits you earn. The rate is basically floating. It's not, you multiply all these numbers by a number that should be 4% in your mind, but it's actually a floating rate that's right around 3.3% right now. And in the 9% column, it was actually fixed at 9% through the end of 2013, and then it will be floating again after that. So the rate right now would be about 7.3 if it were floating. So this is a lot of information for one slide, but we're going to go through a 9% calculation and contrast it with a 4%. So we have two columns here, one for the rehab basis and one for the acquisition. And so I will tell you that we didn't talk about this, but when you do an acquisition and then you rehabilitate it under the 9% program or the 4% program, you basically can earn tax credits on the cost of the acquisition as well as on the rehab. So the first column is the rehabilitation column, and you'll see there that that under the rehabilitation column, the total basis, it says it's $5 million. That basically means that the project is spending about $5 million on renovation and soft cost associated with the renovation, which could be the architect, the financing fees, those types of things. And then you drop down, if you had, there's certain things in which you would reduce that number by if you had grants or you had historic tax credits. This deal does not have either of those. And so what we're left with is what we call eligible basis. That's the amount after you reduce the basis from any of those numbers that would be above that. So that remains at $5 million. And then this one is in a qualified census tract. So the next line you'll see multiplies your basis, your $5 million, times 130%. So it gives it the 30% basis boost is what we call that. And that increases your basis to $6.5 million. And from there we look at this project and it says applicable fraction and the total qualified basis. And you'll see 80%. Well, that means that 80% of the units are low income. And so you must multiply your new basis amount by 80% to come up with $5.2 million of basis. And then the applicable credit rate is shown as 9%. So this is shown as the fixed 9% rate, which is only good through the end of 2013. And some folks right now are actually going back to the floating rate because a deal that's put together today will not be built probably before the end of 2013. But for simplicity's sake, we've left it at 9% for this example. So if you multiply that basis times 9%, you'll see that you'll have the credit that's supported by the basis of just under $500,000. This is a 10-year credit, so you multiply that number by 10 years, and you get $4.68 million of credits. That's how many credits are earned by your investor over a 10-year period. You go to your investors, and they pay you a price for these credits, and that's how you get your equity. And they go ahead and pay you for all 10 years worth of credits at the front end, or relatively close to the front end. In this case, this seller is getting 85 cents on the dollar. They're getting 85 cents for every dollar of tax credit. So they're generating an amount of credits of 3.978, so almost $4 million of tax credit equity. And then there's a little math there that the investor actually only buys the 99.99% of those credits, so then you see that it gets reduced a little bit. So the investor in this example is going to give them $3.977 million for the rehabilitation credits. And then in the next column, you'll see acquisition. So it's the same math with one exception. In the acquisition column, the basis is generally going to be that price paid for the acquisition, not including the land value. So in this case, the property is worth $3 million, or the property is going to be valued at $3 million, not including land value. That's how you get the acquisition basis. And you march through the same math with the exception of at the applicable credit rate, you're going to use the floating 4%. And that's because for acquisition credits, you don't use the 9% rate, you use the 4% rate. And you come down to the end of that column, and the amount of tax credit equity generated for acquisition is $673,000. If you were to add those two up together, you come up with the number in red, which is, forgive me, $4.650 million, I believe. And that's the amount of equity generated by the 9% program for an acquisition rehab project. Now, if you contrast that with the 4%, and we made this example exactly the same with one exception, and the exception is in the rehabilitation column under the applicable credit rate, instead of using 9%, you use the floating 4%. And so this is a 4% deal. This is not competitive. This is something you would get if you were doing a tax-exempt bond deal. But you'll see here that the credit amount is reduced, the equity amount is reduced in the column, if you look at the bottom of the rehabilitation column, of $2.1 million. So if we go back to the other slide, which was $4.6 million, in a bond scenario, it's dropped by over $2 million, $2.5 million. So the difference between the 4% and the 9% in this example, assuming both were available to you, is that the 9% program requires you to go through a competitive process, which creates uncertainty and creates upfront costs that might not be recouped if you don't get the award. But the 4% deal does not. However, it nets you much less equity. So eligibility for tax credit projects. The project must be a residential rental property, meaning we're not talking about commercial properties, although there is an allowance that you can have, I believe, 10% or so of your floor space dedicated to commercial activities. And then, of course, you always can have what we call community space and things that are passive and don't collect income but are available to tenants. You must meet one of two occupancy threshold requirements. And these are the two rules, and most people meet the 50 at 60 rule. So this just means that either 20% of your units must be at 50% of area median income or lower, or 40% of your units must be at 60% area median income or lower. Most tax credit projects that are 9% operate with most all of their units at some sort of level of affordability. This would be more applicable and more of a question for your bond deal, your 4% tax credit projects. Those are the ones that typically might have a mixture of market rate and affordable folks. Next, you must restrict your rents, including your utility charges in the low-income units. This means that we calculate the maximum rent that can be charged, and we include a utility allowance in that calculation. The properties that are financed with tax credits must operate under rent and income restrictions for 30 years or longer. And that's done through a land use restriction covenant typically, which is very similar to the use agreements we talk about under HUD financing. And then again, the ownership for a tax credit project is typically a new limited partnership or new LLC. Additional factors to consider. We've already talked about the LP, the limited partnership. This first bullet is to talk about the LP and GP roles. The limited partner is your investor. They're the folks who bring in all the money, and you're guaranteeing them that for 10 successive years, you're going to deliver tax credits to them. So they're asking you as the general partner, or maybe you're the co-general partner, to manage and operate the property in compliance with those use restrictions for at least the first 10 years, and typically it's a requirement to go through what we call the 15-year compliance period. As such, the limited partner isn't involved in the day-to-day operations. If you were an owner and you had owned your property as a 100% owner, and you were moving your property into a new limited partnership or LLC, you were going to retain the day-to-day operational control of that asset. But you must do so within the compliance program of the tax credits. So the LP and the GP work together, and the GP, the general partner, is expected to be the day-to-day operator. Another thing to note is that if you are currently property tax exempt, you often are going to lose that property tax exemption or experience some sort of abated property tax under the tax credit program, which is brought on because you are moving your property from a nonprofit, generally a nonprofit owner, to a taxable limited partnership. The long timeline is a note because especially in the competitive 9% program, one thing to note is you usually can apply only once per year, and some states have 2 application cycles per year. And so you can't just apply for tax credits whenever you want. So you must be beholden to the application timeline. And then once you put your application in, there's of course a review and award period where the state, takes some time to award it, and then you're beholden to that time period. And because these are complicated transactions, from the award date to the closing date can often be a pretty long time. And we just let people know that it's something to be ready for the long haul in. Even the good side, the upside is it nets you more equity than pretty much any other program you could imagine. The next bullet says significant pre-development cost, and these aren't to be ignored, and we went through some of the pre-development costs to get into the FHA program. I would say in almost all cases a tax credit pre-development process is going to be more costly than any other processes. The applications themselves can cost $20,000 to $50,000 in terms of the due diligence required, application fees. Lots of times you're doing a lot of architectural work to get you into the actual process. And then the last bullet is important, and I've touched on it also. This process and this program definitely requires an experienced and well-capitalized owner and developer partner. The experience is needed because, again, you're taking on compliance requirements that are going to be for 15 to 30 years, and you need to know this program up and down to be able to operate well within it. And then again, the states themselves may have experience thresholds where they require you to have a certain amount of experience before participating. And then the well-capitalized part of this bullet is simply stating the fact that to begin with, you need a lot of money to be able to get into the pre-development program. You need to do the pre-development process. And then secondarily, right now in today's environment, a lot of investors, a lot of syndicators, and a lot of states are requiring pretty large sums of liquidity by the general partner and the owner that you may not have. And again, what we say there is there should be a way to partner, and there should be a way to work with someone who does qualify to get you into this program. There have been some recent processing changes to accommodate tax credits. Again, and we talked about this for a second, the affordable properties can apply directly for a firm commitment in the 221D4 program. Streamlined processing and coordination with tax credits. This is about streamlined processing with FHA products within tax credits. There are modified cash escrow requirements for syndication proceeds. Only 20% of tax credit equity needs to be escrowed at closing. So these are changes from a prior way it used to be that favor, if you knew what the prior way was, you'd see how these favor tax credit programs or favorable changes. There's also deferral of the submission of the final plans and specifications until initial endorsement. Again, this is the 221D4 program. Prior to this change, you would have to submit your plans and specifications at application. This is a delay in that. This lets you go ahead and get your tax credit allocation before you spend all that money, and then you can go to initial endorsement. And then it just says here the commitment, which is the commitment for the D4 money, can be conditioned upon the 2530 approval. In 2012, as we talked about before, HUD's launching a tax credit pilot program to streamline and expedite the approvals for loans for affordable properties that use tax credits to fund repairs. And that's the pilot program with the 223F. It's being launched in 3 or 4 offices, and then it will expand to other offices in the future, as we discussed. So using tax credits to preserve HUD multifamily housing. As noted earlier, we have the pilot program, so we have a way to combine the 223F program with tax credits. Tax credits can be used to raise equity for the rehab of HUD insured and HUD assisted housing. And of course, they may be Section 8. So this is, again, a way to describe the tool that tax credits can be used as with your FHA and Section 8 projects. And then we now have new flexibilities for tax credits, including owners can include the tax credit compliance fee in your Section 8 operating budget. And you may combine the tax credit equity with an FHA loan amount to augment refinancing. So you just basically can use the FHA financing as your debt. And lastly, owners get a developer fee when they do a tax credit transaction, which is often one of the bigger incentives to moving forward with this. We have a few rhetorical discussion questions, and this is what I would say you would ask yourself if you're thinking of moving down the line of a tax credit application. The first would be, will the project be competitive for an allocation under your QAP, which is your Qualified Allocation Plan? This is asking you, do you think that you would qualify and be competitive as a 9% tax credit deal, understanding that it's the most lucrative and helpful to your project? And then assuming that wouldn't work, the next question to ask is, can the project work the 4% credits? 4% credits will not net you as much equity, so the question is, can you live with a lesser amount of equity and support the debt that necessitates? The third question, does the size of the project fall within the 9% allocation plan limits? That's just asking you if there's a QAP limitation on the amount of credits per deal. Does your deal qualify under that cap, or do you need more credits than that program allows for? And then the next question is, what will the timing of the project allow you to wait until you can apply and receive a 9% allocation? And just as we talked about, it's a long process. It's not it's not whenever you want to apply, it's whenever the state allows you to apply. So the question is, do you have enough time to wait for the application process to begin and end and receive your credits and close? If not, we go back to, can the project meet the tax-exempt bond requirements? And that's simply, can it support 50% debt? Can it have 50% debt, which is a minimum requirement in that program? And lastly, just to broadly ask yourself, how can you use tax credits for your HUD project? And again, we would just go through all that. As a closing note on the tax credit program, this is obviously a very, very cursory look at the program. We encourage you, if you are interested in tax credits, to learn where your state agency is, to go meet with them. Often they have trainings, often they have workshops, and generally there's also an association in each state of tax credit developers and owners that wouldn't be a bad idea for you to look into, and those can be often good advisors and consultants and co-developers for you if you want to move ahead. For more information on tax credits, you can go to the HUD website. You can also go to your state agency's website, State Housing Finance Agency's website. And then Novogradac and Company's website has a very nice portal that gives you lots and lots of information about tax credits. In addition, it gives you any new incoming information coming out by HUD or the IRS that would help you in knowing what's going on, what's the latest information. We are going to skip this review question because it did not go with this lesson and go straight to just reviewing the last objective. We were just to recognize the potential benefits that could be achieved through the Low-Income Housing Tax Credit Program. Again, this was not meant to give you everything, but we hope we got a good idea of the 10,000-foot view of the tax credit program and how it might work for you. With that, I will remind you, as we started out, most people who registered should have gotten a pre-knowledge assessment test, and so there'll be a post-knowledge assessment test emailed to every registrant, and we'd ask you to do that and submit it as requested. You'll also get a course evaluation, and you'll also get a letter of commitment request, which asks you to commit to preserving your housing as affordable housing for the long term. With that, that's the end of this webinar. We really thank you for joining us, and we look forward to seeing you in future webinars.